All right, Walmart's latest earnings are out, and wow, it's a real head scratcher of a report. On one hand, you've got a rare miss on profit, but then you look under the hood, and some of their growth engines are just absolutely on fire. So, what is the real story here? Let's get into it.
So, right off the bat, here is the fundamental conflict. Revenue? A beat. A huge one, actually. $177.4 billion. But, and yeah, this is the big one, they missed on adjusted earnings per share. Came in at 68 cents when the street was looking for something closer to 73.
And you know what? The market did not like that one bit. The reaction was immediate, and it was clear. All eyes went straight to that earnings miss, and the stock took a pretty significant nosedive, dropping 4.5% on the day. For a giant like Walmart, that's a big move.
So, of course, that begs the question, right? How can sales look so good, but profits fall short? What exactly happened? Well, that's what we're going to dig into.
Here's the game plan. We'll start with this tale of two numbers, then break down the profit headwinds. After that, we'll check out the powerful growth engines, see what's going right, then peek at Walmart's future playbook, and finally, wrap it all up with our next call analysis to see if the whole thesis is still intact.
All right, let's get right into it. The profit headwinds. Time to deconstruct that EPS miss.
So when you listen to the earnings call, management basically pointed the finger at two main culprits. First, a really unexpected and pretty significant spike in costs for what they call self-insured claims. And second, something a lot of retailers are grappling with, mounting pressure from tariff costs. And that first one, the claims, that was the real kicker. We're talking about a $450 million hit. That's an extra $450 million they weren't planning on spending just in Q2. I mean, that is a massive, unexpected blow to the bottom line. And, just so we're all on the same page, what are these self-insured claims? Well, basically, instead of paying an insurance company, a huge company like Walmart pays for certain legal claims directly. Think things like a slip and fall in a store. For whatever reason, the cost to settle those claims just skyrocketed this quarter. And that's your big profit drag, right there.
But okay, that's the bad news. Management would tell you that's only half the story. So let's flip the script and look at what they were so excited to talk about. The growth engines. This is the hidden story inside that huge revenue number.
And this chart, this really tells the tale. I mean, look at this. U.S. comp sales, that's their bread and butter, right? Up a solid 4.6%. That's good. But then, look over at the digital side. Global e-commerce up 25%. And their advertising business up a staggering 46%. These are the businesses with the fat margins, and they are just exploding. This is what they call their omni-channel flywheel. And you can see why. It's not just one thing succeeding in a vacuum. You've got advertising growing like a weed, e-commerce booming, membership income up over 15%, and get this, store-fulfilled delivery rocketing up by almost 50%. All these different parts are feeding each other and just spinning faster and faster. And the CFO, John David Rainey, he basically said it himself on the call. He said the way Walmart makes money is fundamentally changing. It's not just about the tiny margins on groceries anymore. The real profit growth is coming from these newer, high-margin areas like advertising and memberships. So you hear all this optimism. The question is, what are they actually doing about it? Let's take a look at Walmart's future playbook. Okay, this is the part that really stands out to me. After that profit miss, you'd think they might get a little cautious, right? Nope. They actually raised their guidance for the full year, both on sales and on earnings per share. That is a huge vote of confidence. They're basically shouting, hey market, that Q2 stuff was a blip, the underlying business is strong. And a big piece of that confidence comes from technology, specifically AI. They're building out these super agents, which is a pretty cool name. You've got Sparky, an AI assistant for shoppers, but they're also building agents for their own employees, for things like scheduling, and even for their suppliers to make everything run smoother and more efficiently. But even with all this high-tech stuff, they haven't forgotten who they are. They're doubling down on value. We're talking about almost 7,400 price rollbacks, and they've upped the number of rollbacks in grocery by 30%. They're fighting tooth and nail to be the cheapest option out there, to make sure you and I keep walking in the door. Which brings us to our big finish, the next call. After all that, the good, the bad, the ugly, is the long-term investment case for Walmart still solid? Let's break down the market versus management perspective.
Well, the first reaction from the analyst community, for example, from JP Morgan, was pretty telling. They basically said, yeah, this was messy, but it's not thesis breaking. In other words, they're willing to look past the short term problems because that underlying growth story is just so compelling. And that really sums up this whole quarter. It's the great divergence. On one hand, you have the market, which is totally fixated on the here and now, the profit miss, the tariffs, the stock valuation. But on the other hand, you have management, and they're looking way down the road at these massive structural shifts in their business. So, where do we land? For our next call rating, we're calling this a market perform. Look, the bull case is fantastic. You can't ignore that top-line growth and the explosion in ads and e-commerce. But the bears have a point too. The profit quality concerns are real, and those claims and tariff costs are a wild card. For now, the amazing long-term story feels pretty well balanced by these short-term headaches. So what should you watch for next quarter? It's all going to be about one thing: margin execution. The two questions everyone will be asking are, 1, did those weird claims costs come back down to earth? And 2, are they managing the tariff costs without scaring away shoppers? The stock price is going to swing based on the answers to those two questions, for sure. And this is really the ultimate question you have to ask yourself. Was this quarter just a little speed bump on the road to building a much more profitable, powerful company? Or was it the first warning sign that the profit engine is starting to sputter? The next couple of earnings calls are going to be absolutely crucial. This is not financial advice.